Dave Dredge, welcome back, CIO of Convex Strategies at City Financial. Great to have you back. We tried to get this done 6 months ago, and for various reasons we couldn't get it done. So I'm delighted to have you back with me now in Singapore.
Almost 1 year to the date when we did this last time.
Almost 1 year. And since we did that interview, everybody asked me, the question I get asked all the time is, what's your favorite interview? And I don't have a favorite one, but our conversation is definitely one of my favorites. And so many people have stopped me and said, who's that Dave Dredge guy? Yeah, that was a really interesting conversation. And I went back and watched it again for coming to speak to you today, and it was a really interesting conversation. And so much of the stuff we talked about happened or is in the process of happening. So there's a bunch of stuff I want to go over. And I want to start with risk, because that was really the underlying topic of that conversation. And how people misperceive it, how people misprice it. What does the risk environment today look like compared to a year ago?
Great to be back. Thanks. It was, I too rewatched our previous one. I'm biased. I thought it was fantastic. It reminded me of what I used to think. And risk is still, risk is what I do for a living and help people try to understand risk and mitigate risk. And it's still misunderstood. It's still incorrectly measured. It's still inappropriately regulated. And it's still building in the system. We talked about last time the concept that it's really the endogenous risk that matters. It's not the exogenous shock. The system is constructed around measuring the probability of the exogenous shock, not the amount of risk. I get asked I had lunch with a reserve manager friend of mine just last week, and he asked me the same question he always asks me: what do you think the big risk is for us? And I said the same thing I always say: inflation. And he says, well, we don't think inflation's the risk, we think deflation's the risk. It starts talking about their macro views. And I always go back to the same thing. I say, well, what happens in deflation? Interest rates come down and money comes into your country because the global reserve currency central bank prints money, which makes it spread out in the world. So the value and the amount of your reserves go up. In inflation, interest rates go up and money goes back to the guy who's now tightening this spigot, and the value and amount of your reserves goes down. That's your risk. The other one's your view.
Right, right. It's such a great point.
And people still struggle to understand. We don't buy health insurance or life insurance because we expect to die or expect to get a complicated disease. We buy it because the effect of that is devastating. And yet in the financial markets, people don't think that way.
You've lived through this kind of volatility, a drought, I guess. No one has really cared. This central bank backstop has made buying volatility insurance a complete waste of money. And yet, when we said this last time, it hasn't ever been more important to have that. Have you seen any shift? Are people starting, because weird things are happening. Markets are going up when they feel like they shouldn't. And I get a sense talking to people that more and more people feel like something's not right here.
Yeah, I think a clear change has taken place in my conversations with asset managers around the globe who after being too cautious post the crisis and missing the period that I call winter, where grass neither grows nor burns, and the dark season, they missed the opportunity to accumulate attractively returning assets in that long period, and then get back in on the way up, the spring and early summer, and buy into the belief that the central banks will always fix it, that they will always turn the spigot on and make the grass turn green again. And I think now you're clearly in an environment where people are starting to question the ongoing sustainability of that central bank reaction function, right? And so people are starting to, Bank of Japan, the easiest example, the after effects of NERP weren't what the policymakers wanted them to be.
Well, they were completely the opposite.
Yeah.
Which is important, I think.
Yeah, I managed to bump into a senior official shortly after that, and he asked me questions that I regularly get asked by this sort of crowd. Why does the market not understand what we want it to do?
Right.
And then it proceeded to explain that the strengthening of the yen and the decline of the Nikkei almost immediately after the NERP announcement was unfortunate, but clearly as a result of the higher than expected ISM number in the US and the credit concerns around Deutsche Bank.
Right, okay.
Hilarious. I mean, I don't know if you saw, there was a speech by one of the deputy governors of the Bank of Japan that was published yesterday, talking about their most recent monetary policy meeting, where he lays out what they discussed there, why they did the additional ETF buying and loan facilities and et cetera. And he lays out very clearly, we have a very clear view that the challenges of our economy are principally related to the Brexit and the external economy shock from that. Again, this concept that somehow we're doing everything just right.
Yeah.
But it's all these other variables that we don't seem to be able to control. If it weren't for that.
Well, in the US, it never ceases to amaze me, this idea that if we take rates down, people will spend more. And of course, you look at the savings rate triple, and these guys are scratching their heads. I mean, that's perfectly explicable human behavior, right? Your income's gone down, you're going to save more, not spend more. And so, I don't see where, because someone here is going to have to make a very uncomfortable admission. Either the policymakers are going to have to say, this doesn't work, or people in the markets are going to have to make perhaps an even more dangerous admission. What do you see happening there? Something's got to give.
Yeah, the Minsky moment, right?
Yeah,
is it going to be a voluntary or an involuntary? And even when people seem to be in a position to ease away from the problem, Bank of England, right?
Yeah.
Everything's gone great. Brexit is behind you. People are queuing up to sign trade agreements. You can see that window of opportunity for really structural reform in the efficiency of the economy. Asset prices are through the roof, and the guy in charge slashes rates and buys up more assets.
Yeah. So we're at the point where someone's going to have to admit to themselves that they've made an error in judgment here. Either the central banks have to admit that what they're doing is not working, or the markets have to face the fact that the central banks can't fix it. Which way does this go, do you think?
I think, well, I'd like to have some faith in central banks. And we talked about this last year, that I thought the Fed would hike, which they did eventually, but they would hike because the risks were greatly outweighing the benefits. But they stopped immediately, and they still talk around it, but it's not happening. I thought Bank of England had a chance to just leave it alone. In fact, if you've got a freebie 10% devaluation of a currency, why not hike?
Yeah.
Start to normalize things. But what I think, Graham, and what I think is the big risk in the system now, if you simplify the last time around, 07, 08, the big risk in the system, very simplified, is the assumed correlation of housing prices.
Yep.
And a very small change in that devastated the fact that so much leverage had gone into supporting assets that build in that assumption, that when that assumption changed, the capital supporting that was wiped out.
Yep.
Well, I would argue the big risk now, again, revolves around correlation. And it's the assumed correlation behind fixed income and equities as a portfolio component.
Yes.
Right? And what has escalated exponentially in the management of traditional asset portfolio's, call it risk parity. When I write my monthly letter, I refer to it as risk purgatory, because that's what it's going to be. Because the stability of that, because of the central bank reaction function of always slashing rates whenever asset prices decline, has built in a great deal of reliance around a strategy that allocates risk and leverage based upon volatility.
Yeah.
And so the component of those that is the least volatile gets the most leverage on the assumption that in a dislocation they'll move in different directions. I think that's going to be very difficult to meet the requirements embedded in that when interest rates are this low.
Yeah.
Bernanke cut Fed funds 500 basis points last time. Yellen's not going to cut 500 basis points.
She'd love to, I'm sure.
I think she'll find it challenging.
Yeah, exactly right. But
And
then,
so to me, it's not so much the market's going to force it to change; it's just going to happen. The old Stein's law: if something can't go on forever, it will stop.
Yeah.
And not because somebody does something; it just will.
But it's funny, that's a fascinating point. You talk about that, and I've quoted Stein's law so many times, and every time I quote it, I then get to negative interest rates, and you kind of think, well, hang on a second, there's something that in the short term is absolutely disavowing Stein's law in front of everybody. I mean, how long does that go on for? Because you kind of think, well, it can't happen, then it does. Then you say, well, it can't go more than a few basis points, and then you see the Swiss curve negative out to 50 years. Yeah. How does that resolve itself?
Yeah, you may have seen this before from me for years, maybe for decades now. I've commonly commented presentations and put up a slide that's, the old joke, what do 10-year JGB yields and Japanese bank equity prices have in common? They're both on their way to zero. Well, now we've got negative.
Right.
But that's actually raised this problem that these businesses, banks, insurance companies, pension funds, that have grown up around the servicing of savings are going out of business.
Yeah.
And they are all going to go out of business at negative interest rates. And so I think Japan's always being ahead of the curve, having gone further down the rabbit hole, has taken it. So in this conversation with the guy who said, well, this Nikkei came down because the Deutsche Bank credit problem. Right. And I said, I don't think you can lay that claim for what's continued to happen to Topic's bank index.
Yeah,
which is clearly linked to the monetary policy.
But there's this policy reaction which has essentially crippled every business unit that the banks have one by one. Whether it's Dodd-Frank crippling proprietary trading, or whether it's negative interest rates crippling their net interest margins.
Right.
They are taking apart the most systemically important sector of every economy. And you look at Deutsche Bank share price, you look at Credit Suisse's share price, you look at what's happening in Italy. This is a problem that's not going away anytime soon and is a huge systemic risk. We're back to risk again.
Yeah. And so they try to overcome that with these lending facilities to try to directly give profits to the banks.
Yeah.
So the central bank literally is just directly handing profits to the banks. It's amazing that they're unelected officials. Right?
Yeah.
Try getting elected on a campaign of I'm going to transfer profits direct into the pocketbooks of the banks. And yet central banks get to do it every day.
But what's the way? Because Deutsche Bank cannot be allowed to go under. It's not just a problem in Germany. This is a globally systemic risk. What happens there? Because if you look at they are going to zero. Those shares are going to zero unless something materially changes. Yeah. Do you see? I mean, is that just another bailout in waiting?
But we've all written in law that we won't bail out the banks again.
Right.
We have living wills. We have stress tests. We have bail-ins. We have all this stuff. That's why markets go in great big cycles. We stretch that elastic band as far as it can go, and then it snaps back. All right? We inflate and distribute wealth, expand wealth segregation through the inflationary policies that governments and central banks are on. And then we have recessions, and that segregation narrows. And then we start going back the other way again.
Well, we used to. I mean, let's talk about recession because it's another great point.
I'm sure we'll still have one someday.
Well, someday, yeah. It's going to be a doozy of a snapback. I mean, when we talk about recessions, more and more the data coming out of the US suggests that we're in one. This is not a question of whether it's going to come soon or we're going to muddle through. The data would suggest that we're in a recession in the US. And generally speaking, when recessions occur, bad things happen and dead bodies float to the surface. Everywhere I look, I'm desperately trying to find a ray of sunlight that I can look at and say, okay, well, here's a way that we can see something positive happen. And I really do struggle to find that. Do you see anything, this idea of recession in the States, what do you think about that? And B, is there anything that you're looking at where you see a shaft of sunlight?
Yeah, I'll go back to, I was talking to some central banking friends of mine, and I was, as I am, I was critical of monetary policy sort of the world over. And a good friend of mine says, Dave, you sound like your attitude is central bankers shouldn't try to prevent recessions. That's just ridiculous, right? And so I went to him, I said, think about, he knows me well, think about my fire analogy.
Yeah.
It's like some crazy person saying, I think you shouldn't prevent and put out every fire that starts because eventually you build up so much fire risk, all of Yellowstone Park burns down. And scientists all know that to be true. And yet in the financial economic management world, we think that somehow it's not true, despite a lifetime of the world history of it being true.
Yeah.
So, by constantly protecting or cutting off the correction of this, eventually that rubber band gets stretched further and further, and the snapback becomes more extreme and more severe. Now, obviously, we know how the Great Depression ended. We know how the economic policies that Abe is proposing based upon the successful reflation and debasement of the yen in 1936 ended.
Yeah.
And yet here we are again. Everyone's out there trying to inflate and choosing to use as their measure of inflation indexes that are do not include what's inflating,
Right.
or are fixed through hedonic adjustments and all these things that do not, in the U.S., healthcare costs are through the roof, education costs are through the roof, on and on and on. And yet, again, reading this Bank of Japan speech yesterday, the guy pointing out that the reason they're not achieving their inflation target is because oil prices have come down.
Right.
And so they've got to figure out a way to offset. Well, wait a minute. Obviously, lower oil prices in Japan is good.
You would think.
It has to be good. How are higher prices of anything good?
Well, this construct has been going on in slow motion for 40 years. I've asked countless people to find me an adjustment made to the CPI calculation method any time in history that resulted in a higher number. And no one's yet been able to do it. If anyone watching this can find it, I'd love to see it. But everything's been done to bring that number down and down and down and down. And now here we are. We need a higher, you need that higher print, and you can't get it.
Well, you could get it easy just by
include
the stuff that you're excluding.
Right. But that would obviously result in another huge about turn, which would chip away at confidence.
We talked in the last interview about my former Bank of Japan monetary board friend, who I had criticized about supporting QQE, et cetera, and had given me the great answer about the ultimate causes of the deflationary pressure, the excess debt, excess employment, excess investment. So he was in town back in the springtime, and we had lunch, and he conceded, what he thought was conceding. He said, I concede you're right, Dave. Monetary policy has done all it can do. It's gone as far as it can go. This was after NERP. And I said, well, that's not what I was saying, but thank you. He said, but so it's clear, and this is after the G20 meetings in Shanghai, where everyone had come out with the same thing. So it's clear it's time for fiscal policy to step in. And it was just, swear to God, coincidence. I happened to have with me, because I'd had a previous meeting with an analyst friend of mine who had done some work on Japan, I had with me a bar chart that had the quarterly fiscal deficits of Japan going back for 27 years. Right? So imagine, here's the zero line. You got bar, 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 bar. And I showed it to him. I said, so what you're saying is just a little bit more of this.
And what was his response?
His response was, you make a good point.
But this is it, right? This past the parcel. We're now back to fiscal spending. We're in the age now of helicopter money. We all know it's coming. The flags are too.
That's the big talk, right? Helicopter money. So Japan's case, and so obviously it's been very actively talked about. And so, what would helicopter money actually do? It would put more assets on the Bank of Japan's balance sheet and drive up more government debt and fiscal deficit spending on the government. I can't help but think if the solution was assets on the Bank of Japan balance sheet and running fiscal deficits in the government, if that was the solution, we would have knocked this thing a long time ago.
It's the next solution, though, to an intractable. Look, we all know what the solution is, right? The solution is a real deleveraging.
Yeah.
That's the solution.
Yeah, this is why I said to my friend that the solution is less government, not more.
Yeah.
Right? It's killing the overinvestment. It's killing the overemployment. And again, another thing I get accused of by my more Keynesian or leftist-minded friends is, you just want people to be unemployed.
Right.
I said, no, for the good of the economy, I want people to be productively employed.
Yeah.
Right? If we keep supporting businesses that can only survive if they can borrow at 0 to repay what they borrowed at 1, right? You're employing a whole bunch of people that are not adding to the productivity.
Hey, I'm just amazed that you've still got Keynesians that consider you a friend after some of your statements. But look, I mean, this is where we are, though, right? We're in this world where, okay, that didn't work. Now let's try the same thing, but somebody else doing it. We know that's not going to work. And if you look across the globe, you're seeing global trade declining. You're seeing global growth declining. There is no solution to this but the most painful one. So let's assume they're not going to do that voluntarily. They're going to keep doing this. They're going to keep trying to stimulate. I'm seeing signs that the confidence the market has in these people is starting to ebb away.
Absolutely.
And we spoke about this a little bit last time. And I should say at this point, for anyone watching this who hasn't seen that first interview, they should go back and watch it because it's a fantastic thing to watch and still timely, I think, a year on. But let's assume that that's what's going to happen. What do you think the dominoes will be that lead to that loss of confidence? Is it something that's unknowable, it'll just happen, or is there a clear path to it, do you think?
On that point, I did a piece back earlier this year where I simply got numbers off of Bloomberg or BIS databases, just showed that the bulk of growth in a number of large country blocks, virtually all of the growth was attributable to declining imports.
Right.
Right? And the explicit policy of all of their central banks was to suppress imports. The policy explicitly is to suppress demand. And then they all go meet in Shanghai and don't talk about it. Find it unbelievable. They go to Shanghai and criticize China.
Right.
It's amazing.
Well, it's rude, if nothing else.
Everyone acts like, again, we had talked about this last time. Are they stupid or are they doing this on purpose?
Yeah.
The Bank of Japan is explicit, right? This policy, QQE and negative interest rates, is to affect this price index through raising import prices, through weakening the currency, right? They're explicit about it.
Yep.
Well, that reduces demand for the global product, and then Europe's doing the same, and England's doing the same, and maybe the obvious answer right now is it gets resolved at the ballot box.
Yeah, well, that's a great point. We're seeing that. I mean, that's starting now to. It was an inevitable outcome. The Brexit again was no surprise to me. I thought it might happen. It was a slightly bigger victory than I'd expected, but it's happened, and I think the ramifications are still to be seen. I mean, it's already been, as you said, blamed for a whole bunch of things, which is very convenient. What people have tagged on Brexit, which is it's laughable really, but it's convenient. But we've got referendums in Italy, we've got elections in France and Germany, and we've got, of course, the US election in November. Any single one of those, the outcome is completely unpredictable at this point, and potentially very dangerous for the status quo. Which of those do you think is potentially the biggest?
Yeah, I think for obvious reasons, the U.S. is the biggest, right? The U.S., the whole cycle, the expansion and contraction of credit, that is the cycle, is first and foremost driven by the reserve currency, sort of the godfather of fiat, is the source of all leveraging, right? Of all credit creation, and you've already seen you've seen Trump say, if he wins, the anti-establishment candidate, you can no longer think of him as Republican and Democrat. It's establishment, anti-establishment. You've seen him say he would sack Yellen if he got the job. One of his friends' advisors did an op-ed explaining that the issue is wealth segregation, and the number one driver of that is Fed policy.
Yeah.
And so you hear whispers about it. It would have been far more interesting if it had been Trump and Sanders, because then both sides would have been arguing who was going to clamp down on the Fed the hardest.
Yeah.
Now it won't be as much noise because only, one side will be making the other side sound like a crazy person saying that the Fed does anything but great work. I say it's become a common statement in meetings I have now, and we talked about the challenges in terms of fiduciaries managing risk. Fiduciaries overcoming their short-term return-linked incentive structure and thinking about terminal values of capital, right? And the ability that the institutionalized risk methodology, things like value at risk and traditional, allow them to say, well, the model was trying to predict lightning strikes, and when this massive pile of dry brush burnt because kids were playing with matches, it's not my fault. That was a 6 standard deviation.
Who could have seen that? Yeah.
Nobody could have seen that coming, right? Well, this U.S. election, you can't. If this thing goes wacky, if in this what's going to be, I believe, a very vocal fight of establishment versus anti-establishment, it's going to be dirty, it's going to be noisy, just like Brexit was, right? It's not along party lines, it's deeper than that, so it becomes more personal. And if you're a pension fund manager and this thing goes haywire and triggers, we're late in the cycle, credit is at all-time peaks everywhere you can look at it, so a contraction in credit is due at some point, inevitably. If this is the trigger, can you say, I didn't see that coming?
Well, yeah, you can say it, and they will say it because they'll have to say it. Right?
Yeah.
If you saw it coming, why weren't you hedged? That's the problem.
Which the danger again with the Brexit, right? Right up until the first votes were counted, everything said remain.
Yeah.
Right. Every poll, every media outlet, every senior official, remain. Only once you got the first, the Sunderland grouping of votes, was it obvious it wasn't remain. It was leave. Right. And I think this election is going to be, maybe even more so that way, given the influence the establishment side has within the media, within the traditional process of polling. Because again, it's the establishment from both of the traditional parties sort of combining together against the periphery and the traditional. This one, I think what's going to make this so hard to call, and this is where I think polls around Brexit didn't work, because the polls naturally make assumptions around historical behavior, right?
Yeah.
And you say, well, the Labour guys vote this way and the Conservative guys vote this way, and we went and polled a section of them, and so we extrapolate that into saying this is the poll, right? But that's not the way that vote was. That wasn't a party line vote. That was a cross-party.
Yeah.
And the same is going to be the case in the U.S. And what I think really will drive it, and what to a great extent drove the turnout in the primaries, is non-traditional voters. Guys, a third of the voter base in the U.S. doesn't affiliate to either party. And generally they don't come out and vote because it's a two-party system, and they don't see themselves as, they might see themselves as conservative, fiscally conservative, but not moral high ground or war hawks. So I'm not really a Republican. I don't see myself, I am socially liberal, but I don't believe in borrowing and spending money and driving up the cost of everything and actually penalizing the poor. So, but they might see themselves as either establishment or anti-establishment.
Well, the lesson from Brexit, to me, was one of stigma, and the surprise in the polls was in not understanding just how toxic it was to admit to voting leave. You couldn't tell your friends. You certainly couldn't tell the pollsters, and so it came to shock. To me, the Trump factor is that times 7 or 8, because I spent a lot of time in the States the last few months, and the atmosphere is toxic there. Really, I've never seen a country, or that country, so divided, and nobody gets the chance to say why they vote for Trump. You can't say I disagree with Trump on the Muslim immigration issue, but I think his economic policy is better than Hillary. No, if you say I'm voting for Trump, you're that guy. You're a racist. You're a sexist. You're a misogynist. You're all the things that surround Trump. So people won't even talk to their friends about it. I mean, it's extraordinary. So there's a massive hidden Trump vote, I think, who are not only going to come out of the undecideds, but they're saying they're voting Hillary because establishment, you want to be a good member of the establishment. So I think the potential for an upset is huge in the States.
I think the Brexit is indicative of the sort of momentum that the pushback to the centralization of power and wealth is, and that always happens when this segregation, this rubber band stretches too far. And you hope, again, you hope that the resolution of this from a socio-political perspective can take place at the ballot box, right? As opposed to how it seems to have to take place in North Africa and the Middle East and Ukraine, et cetera, right? So the English, once again, give me great hope that democracy and et cetera can work. It's not completely squelched.
Well, we'll see.
The damn English, once again.
We still have to leave, We've said we want to leave. We still have
now
to
you have to actually implement it. Now you actually have to put people in charge that will endeavor to create free trade and open markets and free market principles, which means people go out of business, which means small businesses can compete with big businesses. I always find it amazing that everybody knows, every study, even dumb politicians will always say that the key to employment growth is small businesses. And then they go out and do everything they can to protect, sustain, and uphold massive businesses that are killing productivity and competition in the system.
Well, that goes around and around. But let's change tack a little bit, get off politics.
Yeah, get off.
Nobody likes talking about politics. One of the other things that we spoke about and you brought up so presciently was the dollar yuan. We spoke about it a year ago, and right after we spoke, and you'd spoken very eloquently about it, we saw the first devaluation again. Something that came out of the clear blue sky, shook markets when it probably didn't need to shake markets because, as you said, it was a perfectly predictable outcome. Where does that dynamic now stand, do you think?
Yeah, so still the same. Back to my fire analogy, that was a controlled burn, if you will, trying to burn out some of the pressure and risk. You had more of the same again in January earlier this year, where they experimented with a new fixing methodology. And yet the overall pressure is still there. So they're smart. In fact, if you really think about it, they started doing this back in early 2014, where they tried to cleanse out some of the excess buildup of the structured product leverage. And so they've been trying to deal with this, but it's hard when you run, you're the second largest economy in the world and you run a picked currency, an artificial, manipulated, not anywhere close to a market-determined equilibrium currency, and you run a split onshore-offshore market, and you have all kinds of capital controls with different levels of advantageousness to circumvent those, and so it's an incredibly inefficient market, and it has resulted in what those always result in far too much inflation behind the veneer of the currency policy, right? And that's what, most simply put, that's the pressure. That's the trillion odd of capital outflow, of unspecified capital outflow, $1 trillion in the last year or so.
Yeah.
And it's very simple, right? You go back to 2007, the value of your Beijing one-bedroom apartment, if you could sell that and get the money out and convert it into dollars, you could buy an equivalent one-bedroom apartment in Bangkok. And now, 9 years later, you can sell that one-bedroom apartment in Beijing and convert it at the current, still more or less the same exchange rate, and buy a 6-bedroom house in Australia, right? Whose market has gone up because of that, right? And that's just inflation and the lack of letting the currency adjust, right? The price of they're giving you a gift if you can figure out how to get your money out. We could make our own guesses of who has been able to figure that out to the tune of $1 trillion, but probably people who have better access to maneuvering the rules than not. Meanwhile, the problem's still there, right? And every time, we talked about this last time, every time they try to address the problem, they're cognizant of it, right? We've extended credit, we've grown credit at a pace that's unsustainable, right? cash flow that's being generated from the utilization of this credit is insufficient to pay back the credit, right? And every time they try to do something about it, the world creaks and the economy goes, and their solution is more credit.
Yeah.
Right? And so you reignite the problem all over again. And now where this gets to the currency, and I'm sure people have seen this, and I think Kyle Bass published some of his research that's actually research from somebody else that he got his hands on. But the simple measurement of FX reserves to M2, which is just a simple explanation of how misvalued the currency has become as you've created this much more of Chinese money and maintained the price of it relative to other money.
Yeah.
And that is doomed. I don't know how Kyle or George, seem to think they know when it's doomed, or how it, some people propose that they'll do a one-off deval. And when people say that to me, I'm like, that's interesting, because explain to me when that's happened before. Because I can't remember seeing that one actually happen and work.
Well, it's interesting. Right now, they're in this, we're not going to devalue, and they're gradually trying to move it. It's almost like, look over there, we'll nudge it a little bit, and hopefully we can keep nudging it, and no one's going to spot it. The two sides of this argument are both very eloquent. You listen to Kyle and Mark Hart and guys that lay out this idea of a sudden devaluation, and their basis is, look, this is not going to be a choice. This is going to happen to them. The market is going to do it. Even though it's a pegged currency, it will happen to them. And then you've got Hugh Hendry on the other side that says, if that happens, the world's over. And both make a very good case. And suddenly, amidst all the other stuff, this idea of a managed currency peg breaking is central to the entire global house of cards.
Yeah, well, which goes back to where we started, right?
Yeah.
You don't per se buy insurance on what you think is going to happen. You buy insurance on what's devastating if it does happen.
If it does happen, right.
So back to your earlier question about risk, what is a big risk? I think Hugh sums it up very well. That's an incredibly big risk.
But how are you seeing people try to mitigate that?
Well, you obviously had the big speculative buildup early in the year. You had all the talk about China, EM, commodity currencies, right? Of course, that ends up snapping back in everyone's face, and everyone misses what was the actual biggest vol event earlier in the year, and it's that nobody talked about either before or after: yen interest rates, right? And everyone just ignored that. So, there's still opportunities in managing the currency risk, both onshore and offshore, and in the NDF world. The relationship between the two, the volatility markets have come back from extremes that they were at early in the year. There's still opportunities in buying protection on credit risk, in things related to that around China. Credit, in the central bank forced search for yield, sort of the two main things I would argue that search has gone into is duration and credit. Mm-hmm. And so those are two things that I think are particularly susceptible to some unforeseen flaw in the sustainability of that process. China is no exception to that. Chinese bank credit protection, or Chinese company credit protection, or people who trade with China credit protection is all, not egregiously expensive.
Now, how does this compare? You were running volatility and credit strategies back in 06, 07. How does, is this analogous, or is it different this time? But how does it compare in terms of the price, the suppression? How does it feel?
It's different, all right? I'll give you a simple example. So, and you've heard me say this, I may have said this in the last interview, that I regularly I used to do a presentation, cause of the crisis, BIS regulatory capital guidelines, Basel I, Basel II. And that's because that, the mismeasurement of risk, the methodology around risk-weighted assets, and how that was utilized to construct super senior tranche subprime CDOs that were zero RWAs, so you could lever it infinitely, and at 1 basis point over treasuries, it was massive revenue, right? So back then, right, the way the rules were constructed, if you bought this asset and you bought this hedge, you could say that that was now risk-free. And so you could lever that infinitely for the difference between those costs. Well, there's been a big kickback from that, and it's gone the other way now. Now it says if you buy this asset and you buy this hedge, I force you to hold capital against the two separately. And so as a bank, in the good old days, you'd buy the asset and the hedge and lever it infinitely and say, I have no risk, even though you knew you had risk.
Yep.
But you say, well, now you buy the asset, you don't buy the hedge because it is less capital efficient. And so it's a different type of risk, but it's still a risk, right? So you have a whole bunch of things that, people buy them that the return shouldn't be what it is. They compress the return because there should be a natural desire to reduce that risk, but it's not. And that then feeds through that so much of the risk, and I'm sure I've seen you talk about this, has been pushed out of the banking system into the asset management world. ETFs, UCITS, these things that again, through a regulatory construct, claim to have daily liquidity that own assets that don't have daily liquidity. So it's become just like a bank in terms of duration transformation. Banks take on current account deposits that are daily liquid, and then they use that to create long-dated assets. Well, now a lot of that's moved into this massive explosion of ETFs and UCITS and money market strategies and so on. And so much of the risk is there. So it's a different type of risk because that's not as leveraged, but it is levered, right? There are repos and hypothecations and leverage and using derivatives and et cetera embedded in that. But it's also has a different type. It doesn't have the same sort of moral hazard risk because the deposit's not a government guaranteed, right? So instead of getting runs on Northern Trust, you're going to get runs on UCITS, which is what we've already seen, right? And if that ever spreads, because I can't get my money out of you, I got to get my money out of you, right? And you actually start a run, and it's not like the last time where TARP could recapitalize these 30 times levered government guaranteed financial institutions and solve the problem. You can't actually go and recapitalize, I don't know, name a big asset manager, BlackRock.
Right.
It's not their money, it's their investors' money. You have to go and buy all the assets, which, again, Bank of Japan and ECB and now Bank of England seem to think is
true.
not
So
unreasonable.
with regards to volatility, we've got this extraordinarily low volatility environment, which is essentially, it seems, through lack of demand, because people, they want the asset, they don't want the hedge. But you've also got a group of people providing the liquidity in that issues that when there is demand, can't offer it now anyway. So, to me, that levers up the problem. When there's a demand for volatility, it seems like the spike is going to be that much greater.
Yeah, liquidity is a weird thing right now.
Yeah.
And the lack of participation from what were the traditional market makers, primary dealers, when you've created such a significant, I can't remember, I saw the number somewhere that the holdings of corporate credit in the asset manager, in the pension funds, et cetera, going into the last crisis was 1.7 times the inventory in banks, and now it's 30 times or something, right? And the banks, are absolutely, very explicit. They're not going to put up any capital to warehouse risk. And so you definitely see that now. In the slightest hiccup, markets don't function. JGBs are the JGBs, which is I don't think we talked about this. I know you and I had talked about it. I've been saying for a long time the inefficiency in the JGB market, the imbalance, the fact that the central bank has taken so much out of the market, was just waiting for a shock lower in interest rates, for there to be a panic to try to acquire assets. And that panic turned out to be NERP. And you had, I don't know, you quote any number of things. 2-year Japanese interest rate swaps had traded in a range of between 10 and 15 basis points for 18 months, traded down 35 basis points in a day.
Yeah.
Right? That's a flash crash. When I say traded, didn't trade. And that's a big issue throughout the system.
Well, these flash crashes are happening everywhere.
And they're happening all the time. Sterling, and Brexit, and
that to
dollar
me,
yen on a regular basis.
I've said this several times, is that's a dress rehearsal for the next severe market dislocation. These flash crashes, they're not anomalies. That's saying this is what's going to happen when we get a rush to the exits.
Yeah, and the interesting thing in Japan and a lot of these markets, you've had a number of high volatility gaps down, right? We had in the U.S. Treasury market back in 2014, and Japan and Korea, and et cetera. And the nature of those markets have tended to address those with declining vol, because the lower yield brings out more appetite for enhanced yield through vol selling. And so you get these big volatile movements, but the actual cost of volatility goes lower. Now, there's a pretty good likelihood that goes the other direction if you ever get the big volatility movement up, right? And you start, knocking out these existing structured note products that are a bet that rates will never go higher, and you start triggering the volatility-based allocation process in the risk purgatory strategies, where they have to, and it's sort of what's happened through time. And again, your more educated watchers will hate me because I don't understand it well enough. But in a sense, in that strategy, you add leverage to what's the lower vol component. And when the other one becomes the lower vol, you don't reduce leverage, you just add leverage on that one, right? And so you're constantly adding leverage as long as vol comes down. When vol goes up, only then do you start to delever. Well,
or try to.
Talk about self-fulfilling.
Yeah.
And I was at a IIF conference, big. So it's World Bank, IMF, Fed, global bureaucrat economists all sitting around talking to each other and having panels talking to each other. And so everyone's talking and talking and talking. One of the panels at the end, they were talking about the challenges of this economy or that economy or the global economy. And the moderator asked a question. He said, you've all touched on, so this is going back probably late last year, you've touched on China, you've touched on Brexit, but what are the potential risks that people aren't talking about? What are the potential unforeseen things? And obviously not one of them can come up with anything.
Is that
They're
right?
like, no, I can't think of anything. Right? And so then afterwards there was cocktails afterwards, and one of the guys on the panel is a friend of mine, and says, grabs the panel and says, let's go talk to this guy.
Come up with
I know a guy, he'll know something. And so, they come over and surround me, and I'm like, what? And he's like, Dave, what do you think is a risk? And so again, my perspective being not what do I think is going to happen, but what is an actual risk?
Yeah.
What would hurt? I said, well, here's an obvious one for you without thinking about it. Here's an obvious one for you. Interest rates go up. And I think there was a Fed guy, an IMF guy, a World Bank guy, and universally they were like, that could never happen. Because if that happens, back to your China story, it's a huge story. If that happens, everything's destroyed.
Right.
And I said, well, that's my point, isn't it?
Yeah.
Isn't that what risk is? Not what your macro view is.
Yeah.
Right?
It's you said perfectly, right? One's your view, right? And that's where we are.
And so that then leads to what I think of the big risk is that correlation, right? And you saw back in the taper tantrum, you saw in January, February of this year, the slightest environment of declining asset prices and rising interest rates devastates people, and you get losses in optimized portfolio strategies that the standard deviations say can't happen. Right? In strategies, not picking on all-weather strategies lose more money than all the science that they utilize says they can lose. And then in the case of January, February, that's simply because interest rates didn't come down enough. Mm-hmm. That's not because they went up. That's just because stocks came down and interest rates didn't fall enough, and you get losses that are outsized. And and then here we are again 6 months later. Guys adding leverage because S&P vol has now come below interest rate vol, and you can see. And when I speak to asset managers, if you even propose the concept of stress testing their portfolio, so everybody runs stress tests now. They all run simplified stress test. If you say, well, have you done a stress test where stocks go down 30% and credit spreads widen 50% and interest rates go up?
Yeah.
No, of course not.
Yeah. What's the point?
Yeah.
we know what that looks like.
No,
we don't need to stress test it.
Yeah, they're like, we run a stress test. It's called the Lehman crisis.
Yeah.
Interest rates come down.
Yeah.
And everything's fine. And our whole portfolio is optimized to that. Because if you did that other one, the losses are multiples of what all your other stress tests say, just by changing that one directionality. And so again, I was speaking to my reserve manager friend. He's like, Dave, what should we be doing to, what's the risk? And I said, the risk is this correlation.
Yeah. But that correlation is everything has got a correlation of 1 now.
Yeah. And again, going back to subprime mortgages and the assumptions around correlation, where has all the leverage built up? It's built up around the belief in this.
Yeah.
Right? It is the fire danger. And it is a complicated one because of its scale and the way it's ingrained. And as my reserve manager friend said, well, okay, you've convinced me, Dave, how do we hedge it?
Right.
That's a good question.
Yeah.
How do you hedge it?
Well, that's it. On that, at that level, you can't. Yeah. You can't, because you own all the risk. You own all the risk.
There's not a nice futures market in correlation between interest rates and equity prices.
But from the bottom up, there are ways to hedge this risk. It's just that they're incredibly unprofitable for an incredibly long space of time while this goes on.
Yeah, you need to, you can simplify. It comes down to convexity, right? It's how do you turn around the convexity in your book?
Yeah.
And how do you, there's not an explicit product you can buy that pays off if this correlation changes, but because of the likely dynamic and impact on liquidity, if and when that correlation changes, there are very convex ways to trigger insurance type payouts.
Yeah.
Right? And conveniently, because of all the leverage that continues to go in this, they're
priced to sell.
Yeah, they're priced very attractively. And,
Yeah.
You call people up and ask them about it, they're like, why would you want that? Sure, you can have some of that, right?
How have those conversations changed in the last year? Because you were having these conversations a year ago, and it's like,
yeah.
Have they changed?
Given what's happened with what we went through August of last year, which in my seasonal analogy is midsummer,
Yep.
right? And so you start getting random wildfires. So all of a sudden the idiosyncratic shocks have picked up, right? But we still haven't had that sweeping correlated shock, right? And so you had the China move and the EM move and the reversal and everything yen, which we talked about last time, and how that was one of the places that was very notably mispriced in the market. And you've seen the turnaround in the pricing of that implied correlation of yen against other currencies. So what is it now, and where are we now? I would argue now we're in the early autumn period where the weather has cooled, and you think because it's not hot anymore, maybe you had an early autumn storm, that the fire season's over, whoosh, right? But then and this is exactly what you're talking about with the central banks, where people tend to get surprised or disappointed, is that early autumn storm doesn't turn the grass green again. Mm. Because ever since midsummer, the days have started getting shorter, right? And so everyone gets overly enthusiastic that this water, which likely has helped put out some of the fires, right? And everyone's programmed to believe, like back in the spring, it turns the grass green and the grass grows and everything's fine. Well, when the days are getting shorter, it doesn't turn the grass green. And so that dry grass is still out there, and it's still, at the mercy of kids playing with matches or lightning strikes or whatever, and we're almost without fail measuring the wrong thing. As we talked about in the last time, the brilliant central banks have learned their lesson, so they've parked the truck right by where the fire started last time and built a wall so it doesn't spread. But this time the fire starts on the other side of the wall, and so I think people are cognizant that we're in a much more complicated world than we were during spring and early summer. The beta season, as I would like to call it, right? The central banks are pouring water on the ground, and the grass, which would have turned green anyway, they take credit for turning it green and tell you, don't worry, we'll always be here with the spigots. And then, of course, as we talked last time, the concern is always that when the big fire comes, they don't have any water left in the reservoir because they've poured it all out. And so this credit cycle, we're certainly very deep into it. We've certainly seen a period of contraction, and particularly in EM. So as we talked about, Brazil and Russia, and these guys are certainly well down their credit cycle already. You've seen what's happened with the yen. I mean, all that yen strength, you can call it whatever you want. It's a reduction in carry activity. Mm-hmm. The yen is a funding currency, is used as a funding currency. Japanese invest overseas to get return. When the yen's strengthening, that is a contraction. It must be. It always has been. We talked about this last time. You can look at any yen cross, and you see a very clear indicator of how the cycle goes, right? And we're here, right?
Yeah.
We look somewhat like where we were after the Bear Stearns bounce. All right, it's kind of similar. Now, again, I think this cycle is much more like '98 than it is like '08. And in '98, we know that the reserve currency manager, even as the EM, the surplus side of the global imbalance, was going through their cycle, they were able to kick the can another year and a half. Mm-hmm. I'm not sure anybody thinks that was a good idea in hindsight, but maybe this side can keep going a bit longer, even as the EM side is contracting and slowing. You touched on it. Global trade is telling you something, right?
Yes.
It's not telling you everything's great. Now, you can argue, and I saw a great piece yesterday showing the correlation between global trade and China growth. And that if you believe China's picking back up, as certainly credit's picking back up, then maybe that gives us another brief recovery in that. But you also have to believe that China's ability to throw credit at it in these starts and stops is limited.
Well, certainly the efficacy of that extra yuan of credit, like every credit expansion everywhere, reduces by definition. And they've poured so much into that. It's hard to see how that extra trillion yuan.
So FX reserves divided by M2 is a telling problem. It was a telling problem in the Asian crisis, right? And so anybody who tells you, they've got $3 trillion in reserves, it's nothing like Asia. The reserves compared to the amount of money they've created is dangerously low relative to what was going on in Asia in '97.
Well, so just in closing, all the things we've talked about, there's risk everywhere. This is what you do. You try and mitigate and manage that risk. We've spoken about a lot of things. Is there one of them that to you stands out as the place where it says lightning strike here? Or switching the question around, what's the one thing that people need to have that insurance for, whether they think they need it or not?
Yeah. So I think the one thing is that correlation, is that issue. And I think people need to be cognizant and understand how much risk they're constructing around a belief in that central bank reaction function. Right? And think again about how much leverage is appropriate and how you pursue that. So that's one. Most people, and this has been going on for a while, argue China is the big systemic risk in the system. And that's probably true. If you use as a measure of who's the biggest potential risk, the guy who grew the most credit, right, grew the most grass, then that's probably China. But I can't get out of my mind, and certainly the way I've been focused almost since we talked last time, as the guy who's closest to the end of their sustainability of avoiding big fires is Japan. Right? And fortunately, I have not made a mistake by focusing maybe more heavily on Japan than anything else. It has been the best opportunity from a volatility perspective, currency, interest rates, equities, right? So I think Japan is the first one to get to the end of people believing that they're fixing the problem, not causing the problem. And so I'm very concerned about Japan. And conveniently they, in their announcements from their most recent meeting, they said they're going to reevaluate. Now, I assume that is some way to figure out how to justify doing more, not what I would, my heart would hope that they're going to come out and say, it doesn't work. Yeah. After doing this for almost 30 years, and getting the same result over and
Over.
over again. It doesn't work. I keep saying, every time I see Draghi's press conferences, I'm like, well, why doesn't somebody ask him the obvious question? President Draghi, what do you hope to achieve from these dramatic policies you just announced? Well, I hope to achieve this. But wait a minute, that's what you told me last time.
Right.
Why do you think it'll work this time and it didn't work last quarter or the quarter before or the quarter before or the quarter before? And yet we just keep letting him go and go and go. So correlation between interest rates and equities, interest rates in general, the extension of duration risk in the system is at an all-time extreme, right? Unlike anything you've ever seen. Right? In Japan, every insurance company has the longest duration on their portfolio they've ever had, and they're getting ready to close their business.
Yeah.
There's implications to that, right? And the same goes with the U.S. There was an article, one of the U.S. insurance companies announcing they're going to fire a bunch of people because interest rates are so low.
Right.
It hurts their future earnings, right? And so all these things, eventually gather up and something changes and the cycle works back the other way again. And you get a big fire and all the grass burns and the price of fire insurance goes to highs at the same time that fire risk is at the lows because there's nothing left to burn. And nobody has any liquidity because they've destroyed all their liquidity on the way down. And the one opportunity, winter, when there's a plethora of attractive returning assets available, nobody has any money to buy them. So I talk about this time and again with our asset manager friends. The key to your success isn't annual returns.
Right.
The key to your success is being in a position in this long window. In my seasonal cycle, winter is by far the longest period to accumulate assets here. If all you did was accumulate assets here, you've won.
Right. But unfortunately,
the reason they're cheap there is
right.
because everybody's destroyed liquidity in the process of getting there. And there's times to sell insurance and earn, right, when it's attractive relative to the risk. And then there's times to store liquidity and prepare for the opportunity to come. You can make your own judgments based on where valuations are and how deep we are in the cycle and where corporate earnings and cash flows are relative to credit in the system, where you think we are. But I think the people in the long run that are going to be successful are the people that understand the convexity in their portfolios and the liquidity available to take advantage of opportunities when they arrive.
Well, this is a cyclical business, and I suspect the next time you and I sit down to chat, which I hope is soon, things are going to have changed materially, and I look forward to picking over them with you. Dave, thanks again so much for joining me.
Always a pleasure. Thanks, Graham.